I'm sure you guys have all been seeing the headlines recently making their way around about Oracle. They've recently closed a backlog of, announced a backlog here of $450 billion over the next 5 years, and 300 billion of that coming from OpenAI. So today we're going to talk about is it too late to buy Oracle? So this is some of the craziest growth that's been announced in a while that I remember of. I'm just going to read this direct quote from Oracle. We signed four multi-billion dollar contracts with three different customers in Q1. This resulted in backlogs increasing 359% to $455 billion. It was an astonishing quarter, and demand for Oracle Cloud infrastructure continues to build. Over the next few months, we expect to sign up several additional multi-billion dollar customers, and the backlog is likely to exceed $500 billion. The scale of our recent RPO growth, which is the backlog, enables us to make a large upward revision to the cloud infrastructure portion of Oracle's overall financial plan. As a bit of a preview, we expect Oracle Cloud infrastructure revenue to grow to 77% to 18 billion this fiscal year, and then to increase 32 billion, 73 billion, 114 billion, and 144 billion over the subsequent 4 years. So I just attached a recent graph of, Oracle after the announcement. You can see I'm just showing in a 5 year trend here, but you can see the massive spike straight upward, nearly 40% here. Um, Basically, they're no longer just a database provider. The company's looking to transition fully to the cloud, and they want companies looking for a smooth, easy, and compliant transition. Moving to another company is just a headache, and Oracle having it vertically integrated, you know, is definitely a big thing going for the company. Um, One, to play the devil's advocate there, the bulk, like mentioned before, the bulk of this backlog is coming from OpenAI, which, is ChatGPT, which still hasn't proven yet to be profitable. So, I mean, it's hard to say, if they're already sustaining such losses, if they continue sustaining losses over 5 years, like this projected backlog is, and they're making up almost 80% of the backlog, are they really going to achieve all these revenues? So I think that's also, a risk factor outlying. And then just looking here, if you look at the bottom, Google gives you the quick P ratio, and this is trailing, not forward looking, but you could see that it's 76 times, which isn't cheap. So how'd they get here? It's just been a story of strong and consistent fundamentals. You can see their revenue here in the top line has grown in 2021 from about 40 million all the way up to 59 million, excuse me, in the last 12 months there. We have net income in it has dipped from 21 to 25, but even looking from 22 to 25, it's going consistently up from 6.7 million back up to 12.4 million here. So they remain large company, continue growing the top line. And they had a dip in their net income, but over the past 4 years and the last 12 months, they have been moving forward and increasing it and are back at historical levels. Nah, it got flipped on my screen here, but anyway, the right half here is the first half of the cash flow statement, and the left half we're doing Japanese manga style here. So looking at net income, it's continually, we've already talked about that in the last slide, continually increasing from historicals back up to the 13 million. And then the cash flow from operations, which is like a way more realistic without these accounting, depreciation, fake expenses, and add backs and accounting for changes in net working capital, give you a way more true image of the actual cash flow coming in and out the door rather than an accounting profit via net income. So if you look at cash flow from operations, it actually tells a different story than net income. And you can see it was at 16 million in 2021 and has actually surpassed that by nearly 30% at 21.5 in for the LTM here. So to see very impressive growth in their cash flow from operations. I mean, that's where you want to see the growth, and especially we'll hop to it right here, just on the left screen. The last measure here, free cash flow. You can see is went from 13 billion and has going down here to the negatives. Usually you want to look at cash flow from operations and then the free cash flow to get a more true image of how a company is generating cash and not these accounting forms of profit. So you can see, right, oh, cash flow from operations, what happened? Like, why are we so down? And the reason is the highlight, which is the capital expenditures. And if you see capital expenditures here is 2 billion, 4 billion, 8 billion, 6 billion, that absolutely skyrockets out of the stratosphere. 21 billion, 27 billion. I mean, these are enormous numbers, and that was, one of the huge telltale signs going back in time to realize, they were really doubling down and expanding out on their customer base and what they can offer. So here we got to summarize DCF, and we're just looking at their last 2025 year, their performance they just announced here with a 57.4 billion here in revenue for 2025. So forecasting forward with the 18% growth rate and 24%, 35, 30, 15, and 3%, you can see in the top row. Taking pretty more aggressive approach. We're definitely going to assume here in the DCF that they are going to get these contracts. They're going to stay. And this is 57 billion, and it's growing to in 2030 almost 170 billion, so about 3.5 times growth in revenue in the matter of 5 years. So definitely taking some more liberties here with the assumption, assuming everything pans out and they can kind of benefit from, you know, the customers wanting to save headaches and being vertically integrated with Oracle's cloud and getting off, the historical older, use of the database. But and even with the free cash flow here, we can be a little more generous. Their CapEx spending, as I showed you in the last slide, was a big, driving factor in in the declining free cash flow. So as you can see in 2025, right at the free cash flow about break even, minus 10% in 2026 as they continue to build out to support the huge backlog. Then I'm going to be more generous here and just say, hey, they're going to actually break even in 27, and we're going to start incrementally increasing the free cash flow 5, 10, 20. And the terminal rate, I think a fair rate that they've given guidance on is 33%. So looking at all this and doing, using a 7% discount rate, 1 divided by 1 plus the discount rate raised to the half period, and then plus one for each half period after that will get you, where I'm getting this 96%, 88%, a dollar today is worth more than a dollar tomorrow, and that's because of the time value of money. And the time value of money is calculated right there based off of the 7% discount rate. So you can see a lot of the value, right? If you look negative 6,000 in present value for 26, zero in 2027, which is break even. 2028 was 4.5 billion, and then we climb all the way up to 652 billion in the terminal. So you can see all of the value. I mean, probably 90% of it here plus is coming from the terminal period, which is then discounted. That's why it's discounted at 68% versus the first period at 96%. As it's, further away in time, it's worth less now because we have to wait, and the opportunity cost we give up in earning different money, and being able to earn interest on our money, sorry, is what causes, time, money to be more valuable today versus tomorrow. Anyway, summing this all up, we get present value of the sum of the free cash flows to be 684 billion. They have 11 billion in cash, so we're going to take that out because if you were to buy the company, right, you're going to assume the debt and you could use the cash to pay off the debt. I mean, you'd keep it for operations, but theoretically speaking, you could use it to pay off the debt. That's why we're subtracting it out here. So 684 minus the 11 in cash, and you assume the debt. So 105 billion in debt. That is a lot of debt for a company. So the risk panning out with the backlog, the build out, the company's not making money off of AI yet. I'm a little iffy after the big run up to the price. The price isn't looking too attractive at the moment. I'm getting enterprise value here of 775 billion dollars. Three-quarters of $1 trillion essentially. There's 2 billion shares here. Sorry. So that gives us, based off of our calculated enterprise value and the target share price of $377. It's currently at 273, so there's 38% upside. It's not typically what I like to see when I'm valuing something in a DCF. I want to at least see 65, 70 plus percent to give you a good cushion because very easily you could assume, a 8% discount rate or a 9% discount rate, or you could change one of the growth rate factors. This isn't a science, it's an art. And I'm not trying to sound corny, but if there was one formula that everyone used to get one answer, well then every single the efficient market hypothesis wouldn't exist, right? It wouldn't be a thing. Every single price would have an exact price and you could calculate it, and then everyone would arbitrage that entire opportunity until it got to the fair market price, because everyone has the same exact calculation on how to calculate a value. So in short, what I'm trying to say is that, yes, there are assumptions that can change, but I think I took a more aggressive and optimistic approach, and given the rise in price, is there room and runway for the stock to grow? Yeah, I'm not saying this is a dog by any means, but just for me at this moment, I would like to see a pullback, or maybe bigger commitments in deals and see how the price reacts from there. Because right now, I feel like there are better places to park my money to make money over the next couple of years. I feel like, at least me personally, I already missed out on this. But if you've been in it and you got in it before the big rise here and announce on earnings, keep riding it, and congratulations to all those shareholders.